So after dropping almost 90% since its historical peak, DocuSign stock seems to be recovering, having climbed up around 88% since its 2024 bottom. And as people love chasing stocks, after this recent run-up, more and more people started talking about this company. Besides, DocuSign just joined the S&P Mid-Cap 400, which also helped to drive up this company's popularity. But is DocuSign stock really a good buy at the current price or not? Well, that's what we are going to discuss in today's video. First, we'll understand what exactly DocuSign does, why this is a good business, its weaknesses, its strengths, and in the end we will talk about whether this stock is cheap or expensive. So first, what exactly does DocuSign do? DocuSign is a $15 billion company that provides electronic signature and agreement management solutions. People primarily know this company for its e-signature product, which is used to sign documents online, significantly reducing the time and costs associated with traditional paper-based workflows. After all, electronic documents are far more convenient to sign than physical ones, and they are also much easier to store and search through than physical files. But DocuSign is expanding. For example, they've just launched a new product called the Intelligent Agreement Management Platform.
So what we launched is what we call an Intelligent Agreement Management Platform. And what that means is basically helping companies with every step of the agreement process.
This platform, this product was designed to solve the so-called agreement trap, which is a problem that is costing a lot of money to companies all over the world, as DocuSign CEO explains.
What's the agreement trap?
So the agreement trap is in essence the value loss that companies are experiencing from all this inefficiency and waste related to agreements. So we work with Deloitte to size this, and it may surprise you. They sized the total economic loss from mismanaged agreements, systems, and processes at $2 trillion.
It's a huge number.
$2 trillion. This would be the size of the problem they're trying to solve, according to him.
What's going wrong here? That people are just not reading the contracts, right?
I think it's a combination of enormous waste in the processing of agreements, and then, very importantly, as you point out, once the agreements are signed today, they go to a deep, dark place. Nobody looks at them again until it's time to renew.
Yeah.
But the point is, you spent all this time negotiating, and what you cared about and what the other party cared about is right there in the agreement. We will help you extract that out, and there's a tremendous value in that. Let's say I want to know all of my agreements that are up for renewal in the next 60 or 90 days. I can answer that question immediately. That's simply not possible today.
Ultimately, DocuSign is used all over the world, having pretty well-known clients such as Allianz, Salesforce, Santander, Ducati, Microsoft, and Nasdaq. Pretty considerable clients here. Now, what exactly makes DocuSign a good business? Well, first, its business model. DocuSign operates as a software-as-a-service company. This is an excellent business model because it's extremely scalable, usually having great margins. Besides, DocuSign also operates as a subscription business model. For example, if you look at DocuSign's results, you will see that most of its revenue comes from subscriptions. Around 97% of it, according to my calculations, which is a positive point because it brings a lot of predictability to the company. Because to make money, you don't need to find a new client and develop a new project, for example. No, in a subscription business model, you don't need to start all over again from scratch. Instead, you gain your clients who will use your platform continuously, and the new clients that arrive will only add up to that base. And as we can see here, DocuSign's average contract length is around 19 months. Okay, 40% of DocuSign contracts have more than 1 year of duration, while 60% of its contracts last for less than 1 year. So these are some of DocuSign's strengths. We'll continue to talk about more positive points later, but first let me go over some of the negative aspects of DocuSign, starting with competition. Now, honestly, I don't know how strong DocuSign's moat is, and how well they will withstand competition. The fact is that there are already major players coming into this space, such as Adobe and Dropbox, and this is certainly a very important point of attention. The second negative point that I found is that I don't see a lot of skin in the game here. As we can see here, management owns only around 1.66% of the company, which in my opinion is quite low. So what we have here so far is a software as a service company that operates through a subscription model with recurring revenue, with big and relevant clients and new products in the pipeline. On the other hand, we don't see a lot of skin in the game here, with very low insider ownership. Besides, competition can increase significantly in the coming years. Now, from a financial perspective, we have mixed aspects here, both positive and negative points. But before we dive into DocuSign's financials, if you enjoyed this kind of content, don't forget to hit the like button, and I also invite you to subscribe. So here we have a company with a robust balance sheet, almost 1 billion in cash, okay, while having no debt at all, long-term debt, zero, current portion of long-term debt, 0.2, so no debt. Now, looking at their income statement, so DocuSign in the last 12 months, as we see here, okay, delivered almost $3 billion in revenue. So if DocuSign's market cap is around $15 billion, this means that this company is trading at around 5 times revenue, which is not a low multiple, but that's also far from being a high multiple too. Now, talking about DocuSign's margins, we have here a company with an excellent gross margin. We are looking here at an 80% gross margin, which is simply amazing. This margin has been expanding as we see here. So for example, in 2020, it was around 75.3%, which is already very good. Yet the company has still managed to improve it, and now we have this excellent margin at 80.25%. So going forward, currently DocuSign is working with a 4.8% operating margin, which is still low, but I think this margin can get better. As it happened here, DocuSign's operating margin was quite negative, especially in 2019, right? But since then, it has been slowly improving and turning positive. So that's a good sign. And ultimately, as you can see here, DocuSign is a profitable company. In the last 12 months, they've delivered, according to Seeking Alpha, a net margin, an incredible net margin of almost 35%. But that's inflated by the income tax gain that we've had here. So for you guys to have an idea, DocuSign had an income tax gain of, where is it? Interest expense. Here, income tax expense. But when it's negative, it's a gain. In this case, an $800 million extra boost here. But even excluding this gain, DocuSign would still be profitable, though its results would be much less impressive. Now, looking at their cash flow statement, here, cash flow. Over the last 12 months, DocuSign has been generating a lot of cash, as we can see here. 1 billion in operating cash flow. But there are some issues here. First, out of this 1 billion, 627 is related to stock-based compensation. But anyway, DocuSign indeed generated a lot of operating cash flow over the last 12 months. And since this company is an asset-light business, they need very little capex. Here, capital expenditure, only $91 million. Therefore, most of the operating cash flow ends up as free cash flow. And lastly, another positive point is the fact that DocuSign has been buying a lot of shares, as we can see here, repurchase of common stock. They have been buying a lot of shares over the last 12 months, around $600 million, which represents around 4% of the total current market cap. They've also repaid a lot of their debt, probably all the debt they had. That's why they are currently debt-free. So in summary, these were DocuSign's financial highlights. And by the way, this platform I'm using is called Seeking Alpha, and I will leave a link for it in this video's description with a 1-week free trial and a 10% discount. Have fun! So now that we've already taken a look at this company, the question now is this stock cheap or expensive? That's what we are going to discuss now. And to answer this, we'll use the discounted cash flow method. And by the way, I'm leaving this Excel sheet in this video's description, as always, so you can play with the numbers yourself. So is DocuSign cheap or expensive? Let's play with some numbers here to get a sense of that. So DocuSign has been growing, as you can see here, at 35.7% per year on average since 2016, okay? So keep that in mind. But we won't project here a 35.7% growth rate because that's too aggressive. Instead, as always, I prefer to count on more pessimistic premises, on more conservative numbers. This way, I don't need this company to deliver outstanding results to make money. Instead, let's say that DocuSign will grow at 9% on average, just as they did over the last 12 months. Okay, so let's project here 9%. Now let's talk about their projected operating cash flow. As you can see here, their average operating cash flow margin stands at 11.8%. But the thing is that, as you can see here, DocuSign's operating cash flow margin has been expanding from 10.6% in 2018 to the current 36.6%. Now, I won't project 36.6% as our margin for the next years, okay? But instead, I want to know what's DocuSign's average operating cash flow margin for the last 5 years, which, as you can see here, stands at 22.6%. So let's project 20% here. Okay. Now, talking about our free cash flow conversion rate, which means how much of the operating cash flow ends up as free cash flow, okay? But as we can see here, DocuSign's average free cash flow conversion rate stands at around 71%. The thing is that this metric, this margin, has been expanding, as we can see here. Actually, in the last 12 months, it stands, our free cash flow conversion rate stands at 91%. But that's not what we will project in our DCF model. Instead, we'll project, again, more conservative numbers, more conservative assumptions. So let's type here 80%. So according to these premises and using a 10% discount rate, the fair price for DocuSign stock should be $45.26. So around here. Now, this doesn't mean that this stock won't skyrocket straight to, I don't know, $100. Instead, this means that $45 would be a logical fair price to pay for the stock. And just reminding you, this is not investment advice. Does this mean also that buying this stock at the current price would be a bad idea? Well, not exactly, because again, it all depends on what you think is going to happen, right? So let's say you think that DocuSign will grow at 20% per year. And let's say that you also believe that DocuSign's margins, cash flow margins, will remain high. Okay, so let's say you think that DocuSign will deliver a 25% operating cash flow margin on average, right, for the next 7 years. In this case, we would have a logical upside of around 35.5%. Now, I don't know if that's attractive to you. That's up to you, right? But I don't like to count on such positive numbers for a logical upside of only 35%. Well, anyway, what I know is that I'm not buying DocuSign stock, okay? But I will leave this Excel sheet in this video's description in case you want to play with the numbers yourself in order to decide, according to your own premises, which would be a logical fair price to pay for DocuSign stock. Okay, anyway, that's it for today. I hope you've enjoyed this video and see you next time.